Good morning, ladies and gentlemen. Well, the risk dial still doesn't think very much of this correction. 57 is a perfectly adequate score that indicates that all we're seeing is a normal correction within an uptrend. How far the correction will go and why is what I will examine now. But I'm not hugely bearish of equities, and I still think that they will perform much better than bonds over the medium term. But we certainly do have some downside targets to examine in today's video. But first of all, let's have a look at what happened last week. We had CPI and then PPI. CPI was absolutely horrid. I think Supercore was way out of line. And if Jay was looking for comfort to be able to cut in June, he certainly hasn't got it. So now this is the curve, and this is what the market is discounting now. No longer a cut in June, but now it's July, one in December, and then two more or maybe three in 2025. So what we've done is actually we've taken out one cut from 2024 completely, and we didn't even punt it into 2025. We just sort of erased it. And that is about right. So Jay cannot cut in June, I'm pretty sure, because he just will not have had enough data, enough CPIs to justify that. The employment situation continues to be excellent. There are absolutely no cracks in the real economy. And if that is the case, all he can hope for is for cracks in inflation, and he's not getting them, and therefore that's that. We know what PCE is going to be because we've had the PPI and we've had the CPI, and therefore that can't be out of line. And he has just ran out of time for a cut in June. And certainly at this meeting, all they can do is basically say that we just haven't got enough comfort, and there's nothing we can do about it. We have to wait. Don't forget the meeting is in last day of this month, first day of next. It's just too late. This curve is correct. There's absolutely nothing more to be said about it. We might get a brief pop on this Iranian thing, but it's a sell. End of story. So what happened to the various tenors? This is the 2-year note, and it topped exactly at the line 499. Now, let me tell you how I'm thinking about the 2-year. It's terribly, terribly unlikely to be able to sustain levels above 506, 507. Because mathematically, I've worked it out, if that happens, then you're not looking for any cuts at all in 2024. I've lost a year. And you're looking for very little in 2025 as well. That is terribly unlikely, okay? Inflation is not reaccelerating to the extent that they might be looking for no cuts at all, and even looking for hikes. So we would really need to start looking for hikes at some stage for it to sustainably go above 507. Mathematically, 507 to me is a great level, maybe even 505. And that to me is the absolute top for the foreseeable future in the 2-year note. Now, we might get a quick flight to safety, but nobody ever buys the 2-year note for a flight to safety. What they do is they buy the T-bills, and then mechanically the T-bill spike makes the 2-year note mathematically come down. And where does it come down? It comes down to somewhere like here, this 580, 582 area, 581, and that is about it. And within a couple of days, we're back towards 499. So to me, anything below 483. 482 is a sell on the Sunday evening if we are there. I just think this Iranian attack was much to do about nothing, and therefore this kind of level will certainly hold. If we are here, we're basically negating the CPI, and that's not going to hold, because if nothing more happens in the Middle East, then these are great levels to get in and be short of the 2-year note. Let's have a look at fives. To me, the level that you are no longer bearish is up here at 473, because it very much the same kind of mathematics applies. Tens, I just, they did top out exactly where they should have done, but I think any move back down here towards 438, 439 is again, a sell in the futures, and you're looking for levels up here towards 470. I just can't see that 10s and 30s are going to be affected very much by this. In fact, wars, if they happen, they're bearish for bonds, and they're certainly bearish for duration. So I really don't see what the market can possibly hope for in the longer end. Nothing very good can come of any kind of war, and we're not going to get one anyway. So anywhere around 458 or a couple of basis points lower, I am a seller of 30 years, and I showed you where the 10-year is. As far as the yield curve is concerned, where are the vulnerable tenors? They're here, the 5s and the 10s. Ignore this doesn't exist, this is a mistake on their site. What we are likely to get once the 2-year has stabilized at these levels, as I showed you, is that any further bad news hits the 3s, the 5s, and the 10s, and we start basically flattening out at a higher level. These are the tenors which are vulnerable, the 3s, the 5s, and the 10s, but especially the 5s, I would say. So avoid being long of 5s and use them as a shorting tool, and now I'll show you why. These are the 2s, 5s, and you can see how vulnerable that looks. That looks to me like he wants to go down to 23. And the implication of that would be that the 2-year, as I showed you, reaches a level where it can no longer rise, and then all they can do is take out further cuts, or the bearishness has to be expressed not in 2 years anymore, but something like 5s and 10s, longer durations. And here we go, that would make it come down. If we look at 2s, 10s, they're not really going up, are they? But if we start now looking at 5s, 30s, that is going up. And if we look at 5s, 10s, that is also going up. So to me, the 5-year note is going to be the area that if you want to short something, let's say that the 2-year has reached the target I showed you, above 5%, and you can no longer rise without implying that the Fed is never going to cut again, then what you are going to see is people transfer their bearishness to the belly, and the 5-year note is the one that is going to be really vulnerable. If we look at Germany, it's a completely different picture, completely different. This is the Schatz, it got to 299 and reversal. If we look at the bubble, in the same range. If we look at the 10s, the Bund just could not get to 252. I was waiting for it, and it just refused. So you can see that the picture is completely different in Germany. Germany is in a range. We are waiting for the ECB to finally make up its mind and to ease, and it should ease before the Fed. This idea, I think, that they're going to follow the Fed is wrong as far as I'm concerned. I think they should go first and let the Fed follow a month later or 2 months later, or who cares how long later. But the ECB needs to go. Inflation and the economy are so different in the EU that not going is really silly. And the charts say it. Technically they confirm that that is exactly what the market thinks. So let's look at the differentials. And here we go. This is the 2-year against the Shats. It's about to break out and it's about to go to this 221 level. If we look at 5s, I think that this 231 level is almost sure to trade over the course of the next couple of weeks. And if we look at the 10s, we're breaking higher, and that is going to 220. Let me show you a longer term chart, and I think 220 is where it's going, indicating to me that the longer tenures don't really move all that much, and the movement is more at the short end. So there you have it. Stick to what is simple and what makes fundamental sense and is confirmed by the technicals. This could be a very long-term, bull flag, which we're breaking out of, and it could piss straight through 220 and go to something like 237. It easily could do it. Okay, so you are in the midst of a trend of buy Europe, sell US. You just have to pick the right tenures, and I think all of them are going to go, some more than others, but I think all of them are going to go. You're going to guess that I can't be bearish of the dollar if those differentials are going out, and I can't be. It finally did what it should have done all week, and it broke higher. What are the levels to look at now? This kind of level here, first of all, 106.25, but then later on, 106.80, 90. That's the kind of level you are looking at. In terms of Euro USD, well, on a weekly basis, what you're looking for is these kinds of levels with around 105.27, 105.30. That is your natural support. But your first support has been reached and breached. The next one is right here at 106.20, but we'll probably see that trade immediately because of this Iranian strike. I definitely would not be short here at 105.40. By 105.40, you should be out of any long dollar positions. It's going to reverse. Where's it going to reverse to? Probably to somewhere around 107, and then you can get back in. But the dollar is not going to be weak next week. It could suffer some reversals, but that is not weakness. Those are just reversals. I think the longer term trend, because of the differentials, is for a stronger dollar. The euro yen has actually done exactly what I thought it would do, and it basically stopped everybody out, came back, tried it again, failed, double top, back down. Now, how does this Iranian thing influence euro yen? Well, the yen is a flight to safety currency, and also the differentials between the yen and the euro are going out in favor of the yen. To me, euro yen should start breaking levels, and I think it should go and retest these levels around 158, 159, and play around this 200-day moving average, and over time turn it and break down. I am really beginning to be very bearish of euro yen. And just to emphasize this point, this is a chart of 2-year Germany against 2-year Japan. I think it's breaking down. And if you look at 5-year, that is also breaking down. I think it's time for some euro yen very cautious positions to be put on. I think the trend here is one of breaking down of relationships, and that should really, cement the euro yen move. It's very difficult to know where to put stops in euro yen, but if you are selling 163, 164, above 166, you are wrong. I think it's as simple as that. Gold had a very interesting Friday, didn't it? And I think that spike might have been it. Just on the verge of the Iranians doing something, and everybody got long and everybody got buried. So, what is likely to happen here? Well, the first sign that we are breaking lower is going to be a break of this 23-25 area and a daily close below it. Daily close below there takes us straight down to 2260, where I think you're going to find a lot of support from this middle point of the Bollinger Band. I doubt very much that it can trade straight through. It'll have a vicious bounce from this 2260 area. Don't forget, this is cash. This is not futures. This is a cash. Futures are going to be about 1% higher, aren't they? The June contract. So that will be 2280 or something, and I've got some bids in there for myself for a bounce. But gold, I think, has done the top that it needed to do. And what makes absolutely no sense to me is gold against tips. Key reversal on Friday, and I think that comes down a long way. I mean, if you are not Chinese and you are not going to invade Taiwan, nobody's going to put sanctions on you. So why you would prefer gold to tips is beyond me. But, gold is a very small market, very small. I mean, it's not even 3% of the UST market. And therefore, when a central bank or several central banks decide they're going to buy gold, that's the sort of thing that can happen. Over time, that normalizes. And this is a very good starting point for somebody who is very long of gold to start diversifying into tips. 2% is always better than zero. The oil chart to me looks a lot more bullish than the gold chart. There was no key reversal on Friday. They just got sold off, and that was probably somebody who knew what was going to happen over the weekend, was told to get it a bit lower so that when it opens a bit higher, it doesn't really fly to new levels. I think that if it opens higher, you want to sell it. I really don't think that we are going to be able to sustain this 89-90 area for very long. We will come back towards these kind of levels, 82, 83. I think we're in a higher range than we were down here, but I don't think that we're going to be flying in oil. And therefore that tells me that actually DBC is not going to do all that much. And here is DBC. I think actually next week it's likely to remain in a tight range down towards 2330. This is a chart which needs sideways action before it can go up again. And if you look at it against gold, it basically says that it shot its bolt up here and it's likely to trade 2 or 3% lower. So I still prefer DBC and oil to gold. I think that gold is going to have a very interesting week next week with breakdowns and then very strong rallies. But I think that oil is going to remain steady-ish and much more steady than gold overall. And it's going to come back to, say, 8. So that is quite a big move in favor of oil against gold. I certainly prefer the commodities to gold at this level. Copper is showing a lot of warning signs that it's topping out for the time being. Look how much selling there's been up here. And that to me says that we're going back to this longer term moving average on the weeklies, which is around the 404. Where is 404? Somewhere around here, basically. And that is what I think that copper is going to do. I think all these commodities and metals, etc., are going to come back. I still prefer them to gold, but I think they're all going to come back next week and confound anyone who thinks that we're going to war or Iran is an important bit of news. I think it's much to do about nothing. On to equities, and if anybody thinks that equities are collapsing because of this Iranian thing, all they've got to do is have a look at where we are on the IG weekend, and you can see that basically we are not all that much lower. I don't know, this is a 1 minute chart, let's take it to a 4-hour chart. Okay, so what happened? This is the breakdown in when Iran attacked, and we are nearly all the way back with people short. I can tell you this gap certainly gets closed. So equities are not going to collapse on Monday morning. I just wanted you to be aware of where the market in inverted commas is. It's not a lot lower. Am I in the camp that says that we are likely to see a correction in equities? Yes. Do I think they're going to collapse? Absolutely not. So here we have the whole rally from the low in November, and I think we're going to go and trade this 23.6 retracement, which fills this beautiful gap that we've got here just below 5,000. Do I think it happens next week? Not necessarily. Do I think we're going to open a lot lower? No. Do I think it gets squeezed at some stage? Yes. But now we have a very, very good indication of where you are wrong if you're short. These closes above 51.80. It just should never close above 51.80 again, because now, although it did close before, now we have every moving average on the shorter terms turning, and the reason why I don't think it collapses is because we're right on the bottom of the daily Bollinger Bands. So this is going to be hard work on our move to 51.80. We need, to 49.80. We need time to pass. We need squeezes to happen, and then finally can go down on some piece of random news. I do think that, as I said, I do think we're in a correction. And I think every time it goes up towards 51.80 on a squeeze, you want to start buying puts and put spreads, this being the upper limit, i.e. you want that to be at the money kind of thing, and you want the 49.88 level, which is, let's call it 5,000 in the ES, because as time passes, ES goes down towards SPX. You want this 5,000 level to be your lower put, and you can even do 1 by 1.5s, because I do think it's going to go that way. And if you buy it when it's up here on a squeeze, you really are not going to be risking very much. If we look at the NASDAQ, that will actually tell you why I don't think we can get a huge retracement in SPX. The NASDAQ actually looks very boring and sedate, doesn't it? Let's try and enlarge this, and you can see where the retracement comes in. It comes in at this level, 17,400, and this is the 200 period moving average. We can go down and meet them both and fill this lovely gap here. So do an ABC over time and really then start supporting here. Unless the NASDAQ leads the SPX, I just can't see it going down that much. Now, don't forget that we are beginning to be in earnings season, and the market will be looking to punish companies which miss earnings. Tech companies are the least likely to miss earnings. A lot of other companies are much more likely to miss earnings, and without the big tech really going down, it's very hard to see the market sustaining, SPX sustaining much lower levels. That's why I think we're in a correction as opposed to anything else, a new downtrend, let's say. And the other reason to suspect that we are in an equity market correction, but no more, is that all the foreign markets are showing signs of topping out as well. This is naturally the Nikkei. Where does it have to hold? Well, it has to hold this 38,100, 200 level, because below there it'll probably extend to 37,000. But it's not the end of the world, right? I mean, it's just an ABC, it's just normal retracement. If we have a look at what Europe is doing, well, it'd be perfectly normal to retrace 50% of this move, which would be, support somewhere around here, 47.40. I really don't see that this is anything more than a healthy correction within an uptrend, and you are looking for buy levels, and I'm showing you what the buy levels are. I think the risk reward at those levels, once the market has taken like a couple of weeks to get down there, are very, very good indeed. When will we know that the correction is complete? Well, probably when VIX trades between this 2060 and 2280 area. These spikes into this area are the end of corrections normally, and I'm looking for the VIX to tell me that. The first one will be 2060, and then 2270 would be great. And that is why we're not that far away from it, and these spikes, I think, will happen right when we are at the bottom. The VIX spikes at the bottom of downtrends. So that is all I've got for you. We're in a correction. Look for the VIX to trade in this kind of area to know when to buy equities. And with that, I've updated all the levels. I am not bullish of the twos. I'm not bullish of the fives, especially the fives. I'm going to be using the fives for shorts. If we get to 507, I really want to be long of the twos, and I'll be looking to short fives and tens against it. But the really normal trade, the one that makes sense fundamentally and technically, is to be long of to be long of Germany against the US. It just makes so much sense. Yes, we are, going down, but we see 49.88 in SPX, and we have a VIX around the 22. I think that we are going to be very, very happy to be buying options for the upside or selling in the money puts, something like that. In any case, I do think that we're going down over the course of the next couple of weeks more than up. But there will be squeezes, and I think those squeezes are potentials for put spreads. As I showed you, I think gold could have a very interesting week next week, because if they sell it on the back of this, people are really going to be puzzled, and that is going to cause us to go down to this kind of support level, which probably is a decent buy for a very, very nice bounce. And here I've just put in the link to the IG so everyone knows where the market is trading before the open. It's not like the most liquid market, it's not the most brilliant indication, but it gives you an idea of the sentiment out there and where the people think that the market should open. Anyway, thank you very much indeed, and I'll tweet you actually as soon as the market opens today.